Today, we will talk about flow-through, pass-through entities. A flow-through entity is a business that passes all its income on to the owners or investors of the business. Instead of the business itself being taxed on its revenues, the individual stakeholders are taxed based on their personal income. Businesses set up as flow-through entities are not subject to corporate income tax. The income generated by these entities is treated solely as income of the investors, stockholders, or owners. Any earnings directly pass, or flow through, to the individuals, and so does the tax liability. This means that the owners can apply losses of the company against their personal income to reduce their tax liability. Flow-through entities include sole proprietorships, partnerships, S-corporations, LLCs, income trusts, and limited liability companies. Each type has different tax implications for the owners or investors regarding income and tax liability. An important potential downside of a flow-through entity is that the owners may be taxed on income that they do not directly receive. Additionally, some pass-through entities' owners may be subject to self-employment tax. The big advantage of a pass-through entity is the tax treatment. A pass-through entity avoids double taxation, meaning the business itself pays no corporate tax. Profits are passed directly to stakeholders, and the income is taxed only once at the individual tax rate for ordinary income. Yes, a disregarded entity does pay taxes. However, it's usually treated or taxed together with its owner by the IRS. It reports its income on the owner's personal tax return, similar to a sole proprietorship. Yes, a single-member LLC is automatically a disregarded entity. It reports its income on the owner's personal tax return and is not taxed separately from its owner by the IRS. Yes, a disregarded entity can have employees. The disregarded entity status is recognized only for the purposes of federal income taxes. It doesn't affect employment. The IRS and courts have ruled that a single-member LLC, one of the most common types of disregarded entities, cannot classify an owner as both an employee and a partner. Here are 5 key takeaways. 1. A flow-through, pass-through entity is a legal business entity that passes all its income on to the owners or investors of the business. 2. Flow-through entities are a common device used to avoid double taxation on earnings. 3. With flow-through entities, the income is taxed only at the owner's individual tax rate for ordinary income. The business itself pays no corporate tax. 4. Sole proprietorships, partnerships, limited, general, and limited liability partnerships, LLCs, and S-corporations are all types of flow-through entities. 5. One downside of flow-throughs: owners can be taxed on income that they do not actually receive. Hope this would help. Thanks for watching.